Hello everybody and welcome. Tom Daly here from the Academy of Financial Trading. We are about to begin your 5th lesson in your foundation trading program. This evening's lesson, it's going to be very exciting because we're going to be building upon that previous lesson where we looked at Japanese candlesticks, where we said that those colourful little devices, they showed us who was winning the battle, which I guess would help us to see who may be winning the war. As always, guys, before we get into the thick of this evening's class, let's start out by having a quick look at our risk warning. It's important, guys, that we're all aware of the risks associated with leverage trading. What we aim to do is to help you to mitigate those risks in as far as is humanly possible. So in order to recap upon where we left off, we looked at these areas. We said that Japanese candlesticks were incredibly important for measuring high, low, open and close areas. These are crucial pieces of information. And this evening we will build upon this even further, and we'll speak about support and resistance. Guys, who on this webinar has looked at support and resistance previously or even used it as a way to trade? Who has looked at it in any way before? Okay, George and Ian and Andre and okay, quite a few more have. Trevor, absolutely the tiniest bit, that's okay. If you haven't used it before, guys, don't worry about it. We're going to start from the very beginning. And even if you have experience with it, maybe we might look at it a little bit differently and hopefully then show you the full picture. We're also going to look at breakouts, we're going to look at trends, we're going to look at channels. You see, these are all part of the same family. And the family basically revolves around lines or barriers in the market. Barriers in the market which, if breached, can result in interesting opportunities. So let's talk about them. Support and resistance. They're just like floors and ceilings. Catherine, I'll hopefully deal with the Chinese stock market sell-off a little later on, okay? Let's have a look at the support and resistance for now. In the room that we're all in, if you can imagine, we'd hopefully assume that there is both a floor and a ceiling. Otherwise, you're either levitating or you're watching the evening sky. We say that a floor or a ceiling, it would tend to act as a barrier. And that idea of tending to resist something, that's crucial. Because we can all imagine that if one threw a tennis ball up against your ceiling, it would most likely bounce back down. You would say that that ceiling tended to act as a barrier. But if one loaded a cannon, a physical medieval cannon with gunpowder, and dropped that tennis ball into the cannon and aimed it at the ceiling, one would imagine that that ceiling may not still be a barrier to the tennis ball. Just like a price hits a specific area, it might bounce from it to begin with, but if it is actually powerful enough, it could indeed break through. We say that the floor, the bottom end area, is known as a support point of the market. We say that the top level area, the ceiling, is known as a resistance point. And these are just the terminology that we will be using. We say that they're zones, they are not lines. And what we mean here is that other educators who may want to make trading look easy, they would tell you that these are perfectly drawn straight lines. They will be in the examples that they use, but not in the real world. So we're going to show you how they're not always perfect. There may be question marks over them. They are uneven surfaces, but we're going to show you how to interpret that. So we say that the floor in the market is called support. And the question which some people, Arthur, this is indeed a live class, but the question is along the lines of why does this happen? So you as a trader, and we as human beings, we have an insatiable appetite for that word why. Why is something happening? We prefer to say we don't know why. We prefer to openly admit that we don't know what the future may hold. Anyone who says that they do is simply speaking nonsense. So we say that the price is bouncing because for whatever reason people are trading around that area. It's just that simple. And let's speak about this maybe to resolve your own curiosity. Or I'll tell you what, why don't we ask the question? Why don't we ask you guys the question? Why do you guys think that a price may bounce at a particularly low level? Imagine maybe something that's close to you, something you're familiar with. Imagine your own domestic housing market. And let's imagine that the prices in your own area, they fell from 300,000 down to 200,000. Why might they not go any further below that level? Why might they not go any further below that floor level, below that supportive level? Relate everything back, guys, to something which you might be comfortable with. Relate it back to a car, relate it back to a house, relate it back to a horse if you wish. Whatever it is you are comfortable with and you know a lot about. Why would the price not go below that 200,000 level? You guys know the answer to this. All that we've got to do is show you. Why would it not do that? Okay, and the participation and the engagement, guys, that's fantastic. It's what's going to make this evening an enjoyable experience. So, William, you said because people have a belief that it won't, I presume you're saying, go any lower. That's absolutely fine. Maybe you're saying that people wouldn't think it was worth any less than that. Maha, you're talking about the value of an item. Ligori as well, the real value. James, physical worth. Well, it's always got to do with supply and demand, doesn't it? And that could be related to the assumed fair value. Maybe people simply remember a time where it did cost much more. Maybe a lot of people borrowed money and paid greater than that 200,000, Ben. Absolutely. And maybe then they were unwilling to sell below that level. Maybe there were psychological issues of the pain which it might cause if they sold below that level. Maybe it is the intervention of some third party. If you're talking about a housing market, maybe it is landlords coming in to buy the properties because buy-to-rent yields are actually favourable. Or maybe it's the intervention of another type of third party, maybe like a national bank. Okay, maybe like a national bank. So let's look at this, because there are quite a lot of very valid comments coming in. On this chart that you're looking at now, this is a Euro-Swiss franc chart. And this was a fantastic period of trading. Anybody who can remember that 120 SNB peg will know exactly what we're speaking about here. But imagine this scenario. You are Switzerland. You're an economy which is driven by exporting services or products. Your largest trading partner is the European Union. Your currency is strengthening relative to the euro. If you see on the left-hand side of this chart, you can see that the euro is weakening, so the Swiss franc is strengthening. Does that make sense to everyone? Euro-Swiss franc is falling, so euro is weakening, Swiss franc is strengthening. Now, if you're Switzerland, that's very bad for business, because all of those fine watches and all of those luxury chocolates and all of those services which are provided by Switzerland, they become more costly very quickly. Therefore, you as the Swiss National Bank, the SNB, you might come into the market and you might start buying at 120. And if you buy enough of it, it'll keep the market up. So let's explain why. If you were a seller, why would you sell at 119 when there is a willing buyer at 120? Does that make sense? If there were enough willing buyers at 120, why would people sell at 119? They just wouldn't. It would be a silly move on their part. Absolutely, James. Supply and demand as usual. So what does the Swiss National Bank do? They keep buying at 120. They tell the market that they are not going to let it go below that level. There have been examples of classic failures of that in the past. In the British National Bank with George Soros back in the early 90s, wasn't it? And even now, more recently, with this exact market, with this Euro-Swiss franc market. But before failure, let's have a look and see what happens. Looking at this scenario, let's pretend that we're imagining how the Swiss National Bank feels. They have bought consistently at that level of X, at 120. Would they be winning or losing if the market moved down to Y? Would they be winning or losing at Y? If you paid 120 for something and if it drops to 119, are you in a winning or a losing position? Absolutely, you're in a losing position. And you might be asking, well, why are we talking about this? We're talking about this because there is a clear support area in the market, a clear floor in the market. And what that tells you is that if those people who bought at that area, if they get it wrong, they will all be losing at the same area of 119. And we know that when people lose, they panic, they flee, they run. And how do you get out of a losing long position? How do you do it? How do you exit a losing long position? Just deep, you have it. Absolutely. George, Baz, Sam, absolutely. You get out by selling it. And if everybody sells at the same point, it's going to push the market severely down. Does that make sense to everyone? These areas are very important because they show you where people may lose. And when people lose, they become more predictable and it gives us opportunities. So we can see that this market initially took off and it moved very, very dramatically. You can see those large spikes where third parties are coming in, buying very, very heavily. So we're going to look at support and we're going to draw out a number of examples so you get a much better picture. It's not about how you or we feel about a market. It's not about what a commentator says about a market. It's simply what people are actually doing in a market. It's about trading. It's about like-minded people buying houses. It doesn't matter how much we shout about it. The price of a house can only go up if people are offering higher prices. We are focused upon when people get it wrong, because that's how a market maker operates. That's exactly how a market maker operates. They analyze when people get it wrong and they take advantage of those sorts of opportunities. So let's see what happens when people do get it wrong. Let's see what happens when panic does exist. So this now is a more recent Euro-Swiss franc chart. It's the exact same market. But in this instance, we're looking in particular at this long red candlestick. And we know that that was the 25th of January earlier on in this year, 2015. If we look at the price element of things, we can see that all the way up to that level, we can see it was trading in and around that 120 area. It was that floor which was being supported on an ongoing basis by the Swiss National Bank. And then on the morning of the 25th of January, the president of the Swiss National Bank came out and he openly declared, he told everybody that they were no longer going to support the Swiss National Bank. Excuse me, the 15th, Andrew, you're dead right. Did I say the 25th? Apologies. On the 15th of January, he came out and he said that they were no longer going to support the floor in the market. They were going to let it try and find its true range. So can you see what happened? Can you see what happened next? Can you see that on the 15th of January, that long red candlestick, it went all the way down to 0.87. Absolutely, Yannick. Everybody sold. Everybody who bought at 120, all of a sudden they panicked, they fled, they exited the market as quickly as they possibly could. And with that panicking exit, we see the strength of that long red bar. Everybody fleeing, everybody getting out. Absolutely, Jeffrey, everybody selling. Lots of selling. A very bearish market, Fass. A very bearish market indeed. So that's what happens when a floor breaks. This is obviously a very exaggerated scenario. a very exaggerated scenario, but still it shows you the reaction, it shows you the panic which might exist in a market. So let's look at it, I suppose, in more normal details, okay? This is a euro-dollar support chart. How do we draw these lines to begin with? I guess the easiest way to describe it is if we all remember that childhood exercise of connecting the dots. You literally connect up the dots for a particular item. Can we all agree that over there at number 1 there is a low level in the market? There is a low level in the market where the market bounced up from. Picture a tennis ball coming down, hitting a floor and bouncing back up. So we say that's one bounce. And then we go and connect up the second bounce of the tennis ball. Can everybody see that? We're just connecting up the second bounce. And after you've got 2 bounces, you might say you've got a bit of a floor. And that's how we drew that top line at X. And then you get some lower levels and you connect up all of these dots to form an approximate support area. Now you'll notice that this is clearly not a straight and perfect line because this is not the way the markets work. This is telling you that it's an approximate area where the market is bouncing from. Okay? It's an uneven surface. So let's look at this a little further. We call this uneven surface our no-fly zone, okay? It's not a straightforward line, it's not an exact line, it's a zone. It's a no-fly zone. And Ligori, you don't predict this floor, you're literally joining up the dots of these low areas as they appear until a zone exists. Until a zone exists. You're not drawing that line without knowing the future price, you're doing it based upon the price which has happened. So you build this floor retrospectively. But let's go through a specific scenario, okay? Let us say that a new trader, a trader who is completed a course elsewhere and they might have bought into the hype of financial trading. And let's imagine that they buy at that first green arrow. And let's imagine that they make $1,000. Let's imagine they make $1,000 in that scenario. They make $1,000, they're happy, life is good. Would you all agree that they feel well? They've just gone out, they've placed a trade, they've made $1,000. How do they feel? Yeah, they feel pretty good, don't they? They feel pretty good. They're happy. It's $1,000 or €1,000 or £1,000, whatever you want to be. It's not insignificant to anybody. The second time that market bounces, what do you think they'll do then? They made money the last time it happened. Could we all agree that they might do it again? Would they repeat the exercise, George? Absolutely. Why not? The last time they made money, they've realized they're good at this, so they do it again. They make another $1,000. The third time, what do we think they would do then? The third bounce. What would happen? Absolutely, they're right again. Life is brilliant. They're happy. They're confident. So they would do it again. So the fourth time occurs. So after the fourth time, or maybe even after the third, or maybe even after the second time, but at some point in time, they're going to say to themselves, well, what if I had taken a bigger trade? What if instead of making 1,000, I aim to make 10,000? Or maybe I aim to make 100,000? Can we all see that there is a very high likelihood that they would increase the amount which they speculate? Because they're on a roll. Everything is working well. The market is massaging their ego. So on the fifth time, can we all agree that on that fifth time, on that right-hand side, it would be a much larger position than the first? Can we all agree with that? It would be a much, much bigger position than number one. It would have to be, wouldn't it? It would have to be. Okay, so we've got a clear floor in the market, don't we? You as a trader, you're learning the right methods, and you can see that there is a clear floor in that market. There is an absolute area of support. And we would know that all of those who bought all the way along that floor, they would be in seriously losing positions if the market drops down below that floor, down to X. All of those who bought at Y at the floor would be in serious losing positions if the market moves down to X. So what would we like to do if the market goes down to X? What should we do if the market goes down to that area? What do we think? George, Ian, Clive, Catherine, Josh, absolutely. We'd like to short sell, wouldn't we? We'd like to speculate that the market will continue downwards because people will panic and they will push it lower and lower and lower as they flee and as they run out of the market. They run out of the market. They panic. They flee. So why don't we just step back and why don't we just admit that we don't know what's going to happen? But what if we just put a short sell right down there at S1? So why don't we just admit we don't know, but why don't we place an order to short at that level if there is enough supporting evidence? So that's exactly what we're going to look to do. That's exactly what we're going to look to do. Does that make sense to everybody? Does that make sense, guys? That's exactly what we're going to look to do. So let's move on a little bit and let's have a look at what could happen. Let's have a look at what actually did happen. Okay? So here we have this exact same area. Okay? So that, can you see the panic to begin with? Can everybody see the panic which is occurring in that market? And can you see what happened when that floor was broken? What exactly did happen, guys? Type it in so the information is retained. What happens right at that area? Can you see everyone sold? Absolutely, Ian. There was a panic. Absolutely, Sal. Panic selling. You can see how quickly the market pushed down and pushed down and pushed down. And if you look, this was back towards the end of the last year. This was back in September, October, November of last year. And you can see the level it was trading at that point. Do we all know where the price of euro dollar is now? It's well down even below that level again, isn't it? It's well down below that level again. It's down around 109, 110, 111. Obviously, Greece not helping the euro recover in any way. Okay, so that's what this market is telling us. It's telling us when a floor exists and when all these greedy people are buying and when they're increasing the size of their trade because they think that they're phenomenal traders, by the time they get all the way over here to X, the size of the trade that they have placed is much, much greater than the size of the trade they had placed to begin with. So in all of these positions, when that floor is broken, when everybody is now in losing territory, they've got to exit that trade as quickly as possible. So it pushes the market further and further and further down. They exit their long positions by selling. They are all losing below that 135 level. Does that make sense to everybody? It's not about predicting what is going to happen. Did we know it was going to break the floor at that point? Absolutely not. What we do is we're simply prepared in case it does. So that's the point. We're prepared because we might have a pending order placed at that 134.5 level or 134 even level, so that if, that's the big one, if the market does move down, if that floor is broken, then we will be in the market to the short side. So we use it through pending orders. We use it through pending orders. That's how we take advantage of the move. That's how we enter a market. So that's how it would generate, in this instance, what was it? In this instance, 600, 700 pips, maybe more. So let's talk about gold. Who here has traded gold previously? Has anyone traded gold before? It's certainly topical, it's a market that a lot of people are interested in, but you've got to be careful because it tends to be driven by sentiment and it can turn at the drop of a hat. But looking at this, let's etch this out. You've got a low point, another low point, another low point, several low points. You connect up the dots and you say that this is your area of support. This is your floor. So then you say to yourself, well, that's all well and good. You had a top-end failure over here, another top-end failure. And then you might be saying, well, actually, this is a descending triangle. There is a downwards trajectory. It doesn't matter what we call it. You can see that the market is simply pushing lower. So what do we think about all of that? could we all agree that if the market went down to S, that it might be a partial signal to short? Does that make sense to everyone? If the market went down to S, it would at least support the idea of it moving further down. So we consider it. Exactly how much we would trade or where our stops would be or anything like that, that would depend on our strategy and the other information which we need. But likewise, what if the market went up to L? What if it went all the way up to L? What do we think there, guys? If the market went to L, what do we think we would do there? Absolutely, Joshua. George, yeah, look, you would say, well, you know what? We didn't know which way it was going to go. If it broke up through that diagonal line, then why not say, look, it looks like there is inherent strength in this market. I would like to buy it. So we would look for longs, absolutely. So that's what we do, guys. We don't know what's going to happen next, so we just prepare ourselves for either eventuality. So let's check out what did happen, okay? We got our friend the Doji right here. And then we got this massive bar breaching through, an engulfing pattern, shouting at us to look at shorts. And can anybody help us and tell us what this item right down at the bottom of the screen is called, where I'm etching out now with those parallel lines? But what is that item right down at the bottom of the screen called? Absolutely, who's in with the right answer first? Let me have a look. Andre, you're in, I think, first. Absolutely, it's a new support area, isn't it? Can we all see that? It's a new support area. There is a doji telling us that there is indecision. There is a hammer hammering out the bottom. There's a couple of more doji. All of these factors occurring time and time again. It doesn't matter whether you're trading now or 5 years ago or 5 years from now. These occur time and time and time again. Okay? And let's make one more point. Let's imagine that you are currently on the 5th floor of your building. So this is you standing on your 5th floor. You're happy, you're on a webinar, maybe the sun is shining. So that's you standing on the 5th floor. So this area below you, what would we call that? Okay? Could everybody agree that it is the 4th floor of your apartment complex? And here is your neighbor. Okay? And I accept that you don't have any nose art there. I hope it isn't a massive handicap to you. Apologies for not being massively specific. But can we agree that your floor is her ceiling? So what is supportive to you is resistant to her. Can everybody see that? Can everybody get the idea that one person's floor could be another person's ceiling? It's dependent upon the direction which you're looking at it from. Because people can remember areas of pleasure and areas of pain. They can remember areas where the market bounced previously, where they made money and where they lost money. George, you have it. And for those reasons, this plays out again and again and again. What was a floor now becomes a ceiling. The market then created resistance and kept bouncing between the new floor and the new ceiling, and we find ourselves within that whole situation again. And neither of these areas, or excuse me, either of these areas can indeed interchange. So what do you think that we would want to do in this exact chart? What do you think we would want to do in this exact chart? What would you do? What would we do? Okay, alright, a lot of people committing one side or the other, a lot of people saying long, a lot of people saying short, but in this type of scenario, couldn't we agree that we might have this word confirmation if the market went up to L? And we also might have confirmation if the market went down to S. And confirmation is like supporting evidence. It's not telling us to trade, it's telling us that there is something in favor of considering a trade. Okay? It's a bit like a tick box, if you will. If the market goes up to L, it's a tick box for a long. If it goes down to S, it might be a tick box for a short. Okay? And going on maybe one step further, let's have a look at the market again. we can see that there was another support area. These occur time and time again. You can see that support occurs, support occurs, but panic then exists, maybe that's the word for it. Maybe panic exists once that supportive level is broken. And we can see that panic in the strength of the candle once the support is breached. Everybody panicked, everybody sold. What's the next thing that happened? Another area of support was formed. Can we see what happened when that level of support was broken? Can you again see the panic which existed? You can see that long red candlestick, absolutely, it fell once more. It moved down and formed a new area of support. That new area of support proved itself to be strong. Okay, and if you look, this is taken from March of this year. Even most recently, this area, the same area of support, wasn't it 1147, was tested just earlier this week already. So this area of support continues to this day. It continues to this day. But we can see that stop losses, when traders place stop losses, they cause sell-offs to occur when their favored direction is not met. So that's what we're looking to do. We're looking to trade against the habits, against maybe the uneducated ways of the retail trader. So these areas are very, very useful. If the market hits off a top level area, we say it's called resistance. And this could happen for any reason whatsoever. But what we must focus upon is the stop losses of other participants. We need to know what way they are operating, because we are looking for our opponents. And you might be thinking, well, why are we doing that? It's simply because we do it in every single commercial area. You look at what's being done before. You do it bigger, you do it better, you do it cheaper. Whatever way you want to do it, you go and do it. If you're the market leader, if you're the first into the market, you might pave the way, but you always look behind to see who might be coming after you. When you are trading, you've got to look at who else is out there. You've got to ask yourself, who do I want to work with and who do I want to work against? And we want to work with the brokerage industry. Why do we do that? It's not because we like it, it's not because we like them, it's not because we're friends. It's simply because it makes money. It's just that simple. And then, shockingly enough, we know that individual traders, they have difficulty, and that's putting it very mildly, to make money. So now we know who we want to work like, and we also know who we want to work against. And this is a way of finding where those retail traders are losing, because that's where a market maker will clear. That is the counter retail approach. If we look at GBP NZD, it's the same thing again. You've got a resistance level this time instead of a supportive level. Where the market eventually breached above that area, we might look at longs. Okay? And we can see that there was diagonal support as well in this instance. So resistance is just the opposite of support. And that market had ultimately breached through. It created a fantastic movement to the top side. And you can see that it didn't return back down. Where you'll see these charts, where you'll get them from, will be during lesson number 7 next week. But let's say that if you did go long at X at that level there, you could have your stop loss right down here at SL. And the reason why you might have a stop loss at that scenario is that if you imagine if you did shoot your tennis ball up through your ceiling and it originally breached through it, but then it fell back down within your room, wouldn't we all agree that the tennis ball was not as strong after all? So Dima, hopefully this is a very clear and real example of resistance. But could we all agree with that? The tennis ball wasn't all that strong after all. It might fall back down. So that's what we might look to do. And then let's have a look at Aussie US dollar. The same thing happens time and time and time again. We have a floor, we have a ceiling, we have a breakdown through it. We have a new floor, a new ceiling, and a breakdown through it. A new floor, a new ceiling, and this time a break up through it. A lot of people they tend to talk about very fundamental things at this point in time. They tend to talk about geopolitics. They tend to talk about macroeconomic factors. A lot of people even talk about the weather. We don't care about any of that, because if there is a geopolitical issue, the largest entities will move quickly in a particular direction. When they do, we'll see it on a chart. When we see it on a chart, we'll take advantage of it. Because we can't afford to pay a team of economic analysts into the thousands of personnel, maybe 6 or 7 figure salaries per year, to try to find out the answers for us. So we simply wait until the big boys tell us the way that they are moving, and then we just go along with them. That's exactly the way we operate. And again, let's look a little closer at this Aussie US dollar right here, right now. We can see these exact same resistance and supportive areas. We'll start at that left-hand side. We have a floor and a ceiling. You can see the floor was breached. A new floor and new ceiling was found. Again, that floor was breached. A new floor, a new ceiling, the floor was breached. A new floor, new ceiling, again the ceiling was breached at this point in time. And most recently, again, a floor and a ceiling, and the floor was breached. The floor was breached. And absolutely, Duncan, it doesn't matter which market you're looking at. It doesn't matter which market you're investing in. It's simply down to being able to analyze them from this technical perspective, to try to understand what an area of support is, what an area of resistance is, and then trade accordingly. It's to have the patience to trade accordingly. That's what you're looking to do. And to be honest with you, we don't really care what's going on with the Australian economy. We don't really care what's going on with the American economy, because the time you find out about the bad unemployment figures, or even the good unemployment figures which came out, we would already have taken a position. We would already have taken a position, because we would have a pending order to go short if the floor was breached. We would have pending order to go long if the ceiling was breached. Okay? If you were just reliant upon fundamental factors, you would have to find out the reasons, you'd have to come home, you'd have to place your trade, and that would probably mean that the move has already occurred. So which option would you prefer? Which option would you prefer? Okay? Would you prefer to have an order placed in advance? So Kunal and Phil and a few more people are asking the question, what is a pending order? A pending order is literally where you're able to place an order in advance. We'll do it in a theoretical sense here. You could decide that while the Aussie dollar, US dollar is trading within this range, that you might say, okay, I want to go long if the market goes up to 0.7872. And likewise, you might say that if also it goes down to 0.7554, I want to be short the market. So you're able to place an order in advance, so that if and when it moves to one or the other, your long position at L, your short position at S, that then you are automatically entering the market. Okay, you're just placing a pending order in advance, so that when it gets to a level that you've predetermined might be an ideal entry level, that's where you want to enter. It means that you don't have to be sitting in front of your computer at all times. It means you don't have to wait until the action occurs and then rush home and then try and place it. It simply means that you have the order placed in advance, so that when the market moves to your ideal area, you're automatically entering. So that's what it's done. And it can be easily placed online. We'll be showing you exactly how to do it next week during lesson number 7. Do you pay for orders? Absolutely not. You never, ever, ever pay for placing an order. You only pay if that order is activated. That's all it is. That's all it is. So you can cancel the orders anytime. You do not pay for it. Doreen, you're asking if they have a time limit. Typically not, but you're able to put a time limit in place if you so wish. So what we prefer is to use this technical analysis, to use it combined with a pending order. And that's what we prefer. We prefer to be not late entering the market, because to rely on fundamental factors means that you will always be late entering the markets. Okay? We prefer to use those pending orders to come into the market efficiently. And also, you know what, you get better execution on those orders as well. Let's look at another market. Let's look and see if we can apply these same principles to a different market. We'll look at GBP USD, also known as cable. And again, we're going to track it across from left to right. We have a floor initially, don't we? We have a ceiling initially. Can we all see that the floor was breached? We can see the panic which existed. Once that panic existed, there was a substantial sell-off. Once the sell-off abated a little bit, a new floor, a new ceiling was formed. Okay, then there was a breakout to the upside. Okay, but at that breakout to the upside, again another floor and ceiling was formed. Then there was a breakdown to the low side. And again, when it reached down to the low side, a new floor and ceiling was formed. And let's look at what is happening right here, right now. Right here, right now, we have a new floor and a new ceiling. What makes this one a little bit different, which we'll be leading on to a little bit later on this evening, is that this is not a completely horizontal floor and ceiling. Look, it's a little bit diagonal, but it's still an absolute area of floor, an absolute area of support, and an absolute area of resistance. So that's an uptrending channel. The technical name, if you want to call it that, is that it's an uptrending channel, but it is providing us with that exact same information. You would still be looking at a breakout above that diagonal ceiling or a breakdown below that diagonal floor. So that's what we are talking about. Okay? Now let's have a look at another market, okay? Let's have a look at something like coffee. And what I want to draw your attention to is all the way down in that bottom right-hand corner. So we have that bottom right-hand corner, we have support, we have resistance. Let's zoom in a little bit closer, see what it really means. It's support and resistance. Again, let's zoom in even closer still, make it very, very obvious that here is our floor and here is our ceiling. So what we like doing is we like to wait until there is a confirmed breach, until there is a confirmed movement above the ceiling. Okay, and then if there is failure at that ceiling, we would have our stop loss back within the room. You would consider your stop losses back within the room. If the market also, if the other side of the trade occurred. So imagine it didn't go up. Imagine it didn't go up. Instead, it went down. So the exact same would apply except in the opposite circumstance. You would take an order to the short side if there was a clear breach of the floor. But again, in that short example, your stop loss might be again back within the room. So that you're always protecting yourself. You're always making sure that if the trade doesn't indeed work out in your favor, that you're not risking too much of your own capital. And that's massively important. It's to enter and exit any trade efficiently. And we'll be looking at that risk management side of things a little later on, towards the final week. We'll spend a full hour going through that risk management side of things. Okay, so we like that type of an approach. So we say to ourselves that we never preempt a bounce. We always say that momentum, it's like a train. Okay, it's like a train on a set of tracks. And one would never stand out in front of a train and say that I think that train who's travelling towards me at 80 miles per hour and carrying several megatons of material. You would never say that I'm going to stand here because I think that train will stop and reverse before it hits me. Who would actually do that? Okay, why would you do that? Who would take the chance? Would you not instead prefer to look at a train and say, you know what, that's pretty powerful. And that looks like it's going to keep going. Is that not a more logical argument? It's momentum. A body will stay in motion until something else impacts upon it. So that's the reason why we're going to work with momentum. That's why we're going to use pending orders. That's why we prefer to wait for confirmation. And this idea of confirmation, it's crucially important because it's that which gives us our supporting evidence. When these areas break down, we get support and resistance lines. Support and resistance lines, and that tennis ball breaching through that ceiling, it really is a sign of things to come. So we can measure this on new highs, we can measure it on new lows, we can measure it on breaches of a moving average. There are many different ways to do it. But let's say we're going to just measure it on new highs or new lows. We can look at it and we can ask ourselves a very simple question. Is a new high or a new low? It can be one of two things. It can be genuine or it can be false. Okay, it can be one or the other. If it's genuine, it typically continues much further in our favor. Okay, if it's false, that is the point where we need to have our risk management structure in place, because a breakout which is false would lead to a losing trade. Okay, it leads to a losing trade. So we need to ensure that when that losing trade occurs, and a losing trade will occur, but that it does not lead to excessive risk. Okay, that's massively important to say. So when we're talking about entries, okay, finding entries is the easiest part. We've looked at entries over the past few moments. When a market breaks out, we can look at these areas. We can say that we expect these areas to continue. If a market breaks out, whether it's to the upside or to the low side, we can have a look and we can say, okay, based upon a breakout, based upon strength of movement, based upon momentum, we can say to ourselves that we expect it to continue. Okay, that's the more likely scenario. We can expect that to happen. Okay, it'll go down through a floor, let's say. We can say that it's likely to continue in that direction. Is everybody comfortable with that? We can say that when it breaches through these lines, that it's likely to continue. Okay, until a new area of support is formed. And then it might bounce, and then it'll go back up, and then we look again, we reanalyze, and we ask ourselves if previous support will now provide us with resistance, and would that then provide us with another trading opportunity. In this example, okay, it's a little bit exaggerated, I'll admit, but it's 600 pips to the downside, followed by another 600 pips to the upside. But it's easily trackable once you have just that basic bit of knowledge about support levels and resistance levels. Okay? So let's have a look at Apple, the stock Apple, the equity Apple. And can we all draw our attention right over again to that top right hand side? Okay? And again, quite an easy question I hope to ask. It's all the way up on that top right hand side. Do we think it's expensive or do we think it's inexpensive? Just type in EXP if it's expensive, or INEXP if it's inexpensive. What do we think? Do we think it's expensive or do we think it's inexpensive? It's all the way over there, the top right hand side of the chart, the highest possible point. Is it expensive? Is it inexpensive? What do we think? Okay, we'll look at the time frame along the bottom to begin with, but just about everyone who has typed in the word EXP or expensive, excuse me. The reason why, I guess, is that I think we've been conditioned to think, if you like, that if something is in the top right hand side of a chart, it's got to be expensive, okay? But we got to remember that everything is relative to time. And you don't know what's going to happen tomorrow. But again, look at the timeline running along the bottom of the chart that they've circled in that red circle, that red oval, if you like. It's not a circle, is it? It's an oval. But look at that timeline. It's from July 2011 to January 2012. So now let's go on one slide and let's look at that exact same timeline. From all the way October 2010 into 2011, all the way into 2012. And this area right here, that's the area where most people thought was expensive. So now when we look back, can we now say that, well, you know what, it actually wasn't? Okay? Now do you think is expensive or inexpensive? It's the exact same area that you've looked at, but now it's inexpensive. It's all the way up here now. So the answer to any question, no matter what chart you're looking at, if anybody asks you, is it expensive or inexpensive? The right answer is simply, I don't know, because we don't know what the market is going to do tomorrow. Expensive or inexpensive is what you'd call something if you're shopping for your weekly groceries. If you're trading, you disregard it. You're looking for opportunities, for powerful movements that you can enter with limited risk and to run with the market. You can skip forward to more recent charts and we can see support and resistance playing a key area time and time and time again. Okay, we can see it occurring time and time again. We got a breach of a ceiling up here. It moves on. A new area of resistance and support is formed. There was a breakout again to the upside. So it simply occurs time and time and time again. Does everybody see that? These areas, they're simply areas that draw our attention to. They're areas where you might scale in with something. Okay, so that's all. It's drawing our attention to where other traders are feeling some pain. It's drawing our attention to where normal traders are hurting, where market makers are winning. And that's what we want. We want to be involved in those same areas where market makers are winning. So looking at this a little further, we can talk about exits. Exits are massively important. Massively important. Many people who have traded, you should know that the entries, again, they're quite easy. Okay, you can go through an entry strategy. You can teach people an entry strategy in about 2 hours maybe. 2 hours during our most advanced offerings. That's how long it takes us to cover off entries. They're quite easy, to be honest. An entry, or a trade if you like, a trade is defined by its exit, not by its entry. What you do after the entry, that's what dictates whether or not you're going to make money. You could have the best entry signal in the world. If your exits are terrible, you simply lose. The market wins. Okay? So when we talk about exits, people then ask, well, how many pips should my exit be? If there was one answer, the world would be a much easier place. But there isn't one answer. You've got to basically measure the way that market is behaving as per your methodology. And what we look at, there are things like retracements, things like returning to a range, maybe old support and resistance levels, all of these sorts of levels. That's what helps us. If you're looking at an example, again like this chart NZD-USD, if you had shorted on the breach of the red line, if the market went back up above it to that black line, could we all agree that we would have been wrong? Does that make sense? If you had shorted as soon as it broke down through the floor and the market moved back up, conceptually a stop loss at that black line isn't a bad idea. That's not a bad idea at all. You're limiting your risk. Now again, we can see in this scenario the market didn't return to that black line. It didn't cause a trade to exit at a loss. It pushed down. Everybody is happy. I can see just while this chart is open, I can see there has been a question in about a market gap, as in sometimes the open area of today does not equal exactly with a close area from yesterday. That's called a market gap. Does anybody want a quick explanation as to how these gaps occur? I can draw your attention to one on this chart right here. We can see that the market opened up there at X, but the day before it closed actually all the way down there at the bottom of that red candlestick at Y. So we have a gap appearing. We have some fresh air. Okay, good question. Okay, let's go through it. Okay, I think the easiest way to explain this, we'll use a bit of an analogy again. So forget about this market being NZD-USD, okay? Imagine this chart was simply showing, let me use a good analogy. It was showing, we'll go back to property. It was showing domestic property prices in your area. That's all it was showing. Okay, domestic property prices in your area. And imagine at Y, imagine that this is this Friday coming. Okay, imagine that this is this Friday coming, and that level, whatever the case may be, we'll say that it's 250k. We'll say that that's just telling us that the value of property in your area, the average price is 250k. There's a couple of properties for sale around you, and they're all there or thereabouts within that area. Okay, now imagine the area that you're living in. Imagine it's about maybe, we'll say it's a 30-minute commute from your area in the suburb into the city centre. It's not bad, it's 30 minutes of a commute, that's okay. But imagine over the weekend, when the estate agents close, when the markets close, that the government comes out and they say that they're going to build a high-speed rail network from outside your front door directly into the city centre. So instead of it being a 30-minute commute, it'll be a 5-minute commute. So what do you think will happen to the price of houses in your area on Monday morning when the market opens up? what do you think will happen? Okay, a lot of people saying it'll rise, it'll increase, it'll go up, but will it go up to 251? Okay, what do you think? Will it go up to 251 or would it go up to 300? What's more likely? What's more likely to happen? Would it go up simply by one, we'll call it 1 pip? Will it go up by just a small amount, or would it jump up? So that's how a gap occurs. A gap occurs simply because for whatever reason, there is excessive demand, which makes it jump up, or there is maybe too much demand, okay, excessive supply, not too much demand. There is excessive supply, which would make it jump down. Okay, likewise, that's a gap up. Okay, so the new high-speed rail link, it means that on following Monday morning, estate agents open, it's no longer 250, it's a gap up, it's 300k. But imagine the opposite occurred. Imagine they were going to build an incinerator in your back garden, which is going to deal with all of the domestic waste from the entire suburb within which you lived. What would happen to your house price the following Monday morning when the markets reopened in that case? Okay, would it go down to 249? Or would it reopen at 200? Or maybe 100, I think, if you were lucky. Do you know what I mean? So does everybody get that's really the mechanism as to how a gap appears. It's simply just down to excessive supply or excessive demand. That's all it is, okay? That's all it is. So if you're stuck with something like that, guys, again, I know I've said it a few times, but just try to relate it back to something which you have experience with, something that you are familiar with, that you're comfortable with. Okay, so that's quite an interesting scenario. They tend to occur more often than not during equity markets or in equity markets, simply because an equity market is closed more often than it's open, so that there is that room for movement in the times that the market is actually closed. Okay, so let's have a move on. We're going to look at profitable exits. So a profitable exit, that's what everybody is looking for. We need to know how to manage a trade. We need to know how to exit and how to actually achieve a profit. Okay, so let's have a look at it on a chart. That might be the best thing to do. We want to get out of a market when it clearly tells us to. If a market is rising, in the most simplest of terms, when it stops rising, we look to get out. Okay, we might look at trend lines, we might measure retracements outside of that area, and we say that this might be too much. Okay, this might be too much to take. Okay, so we look at this Apple chart, and that's exactly what we can see in this exact scenario. You might have entered on a close outside of the initial breakout. Your stop might have been back at this level here, if you like, back within the original room. But then when the market pushes on, when it's showing a clear retracement, maybe based upon a bearish engulfing pattern, if it is a bullish position that you have entered into, then you might consider taking your profits. Okay, you might use a moving average. Okay, you might manually adjust your stop losses so that if there is an excessive retracement, then that might tell you that you exit and your profit would be protected. Okay, we like using a moving average. A moving average is another nice way to tell you to actually exit the market. Okay, it's another nice way to tell you to exit the market. It's a clear, it's a very objective way to exit a market, simply because the price had moved towards a moving average area. It keeps things very, very simple. Okay, we like keeping things simple. And yes, you can change pending orders area after you have placed them. That's no problem. So imagine you had a moving average on a chart. So this red line running across the chart, that's a moving average. So imagine we had a scenario where you entered upon the breach down through the moving average. You could have your profit exit at the value of the moving average, so that if the market goes back up to that area, you are out and realized your profit. That's quite nice. Okay, we look at another one. We look at NZD USD once more. This would be a nice one. You would have entered there in the breach through the moving average, and you would have exited right here. You would have taken all of that profit. It's a nice way of trailing in that sort of area. Okay, then we can look at trends and channels. When a market is moving in a particular direction, we can say that it's trending in that direction. All that it means with a trending channel, we looked at it briefly already, I think, in that GBP USD chart, but all it means is that there is diagonal support or diagonal resistance rather than pure horizontal support or horizontal resistance. The effect that it has in the market, it is literally the exact same thing. It is still considered to be an area of support if it's at the lower end of the price. It's still considered to be an area of resistance if it's at the upper end of the price. So we had the horizontal resistance, we had the break up through it, the market came back down, went back within the room, and then we had the break of the floor below. Okay, so both times providing an opportunity, both times providing a clear opportunity. And that's nice, and that's absolutely quantifiable, and it's a nice and a logical and an easy way to actually look at a market and decide upon an entry. Okay, but one of the difficulties I think that most traders find when they do become confident in these types of methodologies is that they might try to look for more entries. They might try to look for areas, if you like, within areas. So you can see a channel like this. You can see there is a clear trend. It's in an upward direction. You can see there is a clear ceiling to the upside. You can see there is a clear floor to the bottom side. But even within that channel itself, you have another clear area which you might be drawn to. So this is something that we try to do. Natural gas was behaving beautifully for us. So what we were looking for was to create a micro area within an overall trend to go against those counter retail trading opportunities. And when you try to find your way into a market, one of the things which we have, one of our own proprietary methods, it's on the screen in front of you now, where we jump in when a candlestick hits the blue bar, it takes off and we capture nice opportunities. That's the type of thing that we like to do. We like to combine everything together to try to find real opportunities which exist. So again, it's down to you not being reliant upon your opinion, if you like. It's about you having a clear and a proven and an objective strategy which you can put in place anytime you wish. A bit like that moving average. A moving average, it's not bad, if you like, but it gives you an objective reason to exit if you so wish. So we're running close on time, guys. What I want to do before we finish up is obviously we want to have a look at a new chart. Okay, because as we say repeatedly, in trading you have to make a decision. If you don't make a decision, you're simply never going to trade. You're never going to be able to enter. You're never going to be able to exit. So this is a current gold chart. It was a hell of a breakdown a couple of days ago, a little bit of a recovery since. So what exactly is going on with this chart? Can you type in long if you think it's going to go up? Can you type in short if you think it's going to go down? Or even anything else? What exactly would you do looking at this chart right here, right now? What is drawing your attention to the current action? What exactly would you do? What would you do? And while you're deciding, why don't we throw in a couple of lines as we tend to do? In that back in March into April, we had a little uptrending channel. There was a little bit of a breach down below. It continued into it. But look at what's been happening most recently. Look at what's been happening most recently. We have a clear resistance point, don't we? We have a clear supportive point. Okay, and at the moment the market is simply pinging from floor to ceiling to floor to ceiling. So now that that simple room, if you like, has been drawn, now that we have a clear floor, now that we have a clear ceiling, tell me what you would do. Is your mind changed in any way at all? Absolutely, it is a downward trend, but would you think that the more logical thing to do was to not entertain all this noise? Don't enter into any of that noise. Why would you not wait until there has been a clear breach of the ceiling to go long? Why would you not wait until there has been a clear breach of the floor to go short? So why not have pending orders placed? Absolutely, Ray, I like the way you say it. You wait for confirmation. Why not forget about this noisy area where retail traders are getting caught up in? Why not just forget about that? Why not just have a little bit of patience, Why not? Absolutely, Christopher. Why not plan a little bit? And why not place pending orders so that if and when a breakout occurs, and a breakout will occur at some point, a breakout will occur at some point. If that breakout does occur, then you're going to be in a position to take advantage of the panic which then will exist. So that's important. It's important to understand that sometimes the best thing to do is just have that little bit of patience, to use that little bit of patience in your favor. Okay? So that brings us to the end of this evening's webinar. In conclusion, support and resistance, they are crucially important. They show us key areas where people might be losing, as do breakouts, as do trends, as do channels. We know that people use them, and that's why it gives us opportunities. Your next step, guys, as always, it's to attend all of the lessons live. Don't forget that during the 8th lesson, this time next week, we're going to be giving away a scholarship for lifetime membership to the Academy of Financial Trading. That's going to be very, very exciting. And in the meantime, we're going to be finishing up our technical analysis. We're going to be providing you with a virtual trading platform, a practice trading platform. And as I say, we'll also be providing you with this scholarship to the Academy of Financial Trading. So what I'll do, guys, is I'll stop again for my usual 60 seconds, okay? If there are any outstanding questions, please do type them in now. I'll do my very best to come back and go through every single one of them to make sure that we all get full value from this, the midway point of the Foundation Trading Program. So many thanks, guys. I'll be back in just about 60 seconds. Take care for now. Okay, guys, let's have a look at what we have. No trouble, Dean. Many, many thanks. Jeffrey, absolutely. Pending orders are the way to go. Phil, you're asking that could be a long play and a pending order at the same time. Yeah, if you wish, Phil. I guess it all comes down to the risk element, to be honest with you. James, you're saying with the gold example where floors and ceilings are diagonal rather than horizontal, which value would you set the pending order at? Surely it would change over time. Absolutely, James, but I suppose that's the beauty of being able to access the markets whenever you wish. You can adjust those pending orders as often as you wish, okay, as often as you wish. I'd probably recommend that you adjust them once per day, or maybe I won't say adjust them once per day, only adjust them if necessary, but it's important maybe to look at the markets once per day, see exactly what is happening, see if pending orders do need to be adjusted because whatever way the market has been moving, and then you can do it. It's no cost to you to actually adjust them. Andre, asking if I trade on a daily basis. I still do, absolutely. Delico, you're asking a question that I think Catherine and a few other people asked a little bit earlier on about the Chinese stock market. Look, I guess, guys, based upon what we've even covered this evening, can you tell me what happened to the Chinese stock market? Okay, we'll say there was a substantial sell-off. I think that's even belittling what has happened to the Chinese stock market. There's been a couple of $1 trillion that wiped up the Chinese stock market in the last few days. Wasn't it 50% of all shares on the Chinese market were suspended from trading to try and halt the sell-off. But look, put it in an understandable way, maybe. Put it in an understandable way. Did panic exist? Do you think panic existed? Do you think a floor was breached? Okay, so that's it in the simplest of terms, really, isn't it? A floor was breached, an area where people were reasonably sure that the market was never going to go below was broken. Okay, and because it was broken, everybody panicked. And when everybody panicked, everybody sold. And when everybody sold, it pushed the market lower. And when it pushed the market lower, more people panicked. And when more people panicked, more people sold. And when more people sold, the market pushed lower. So it's that kind of an exponential action that the more something happens, the more of it will happen until intervention takes place or until it goes back to its natural valuation, because there was a lot of people who did believe that the market was massively overvalued. Okay, so that's all it was. You know, in the simplest of terms, support was breached, panic existed, free-for-all occurred, and that's still in existence today. That's why the Chinese are the People's Bank of China, or the Chinese government and the regulators and everybody else. They're doing every single thing that they can in order to try and stop it. I read actually very recently, maybe 2 days ago only, that I honestly don't know if it was truth or if it was rumor, if it was just something that somebody put up in a humorous for a humorous post, if you like. But I read that the Chinese government actually banned the use of the word panic sell-off or extreme sell-off or something like that. That nobody was allowed to use it because it actually exacerbated the problem. Okay, let me have a look. What else have we got? Adam, you'll be able to access the webinars for at least 1 month after the entire course comes to an end. You'll be able to access the recordings of this course for at least 1 month after the course comes to an end. Peter, you're saying when a market panics, it's usually in an overreaction. Is it dangerous to place an order in the opposite direction for a very limited period? I guess, Peter, if market panics and if you're looking to trade in the opposite direction, it is tantamount to standing out in front of the railway tracks, looking at that train coming towards you and thinking that it is going to stop. If panic exists, if momentum exists, if there is a substantial movement one way or the other, it's probably best to go with it rather than go against it. Especially I think with moves to the short side. More panic exists to the short side than to the long side. There's an old saying in the market that any market that it takes the elevator down, but it takes the stairs up, because people will exit a losing position to the to the short side a lot quicker than they will exit one to the long side. Vinod, you're asking if it's possible to trade every day, every weekday, and I suppose that's a bit of a misnomer in itself. It's possible to trade from Monday to Friday. Johnny, you're asking about the AIM. That's the alternative investment market. It's the kind of a penny market, Johnny. That's what that is. Sebastian, you're asking if there is a limit to short selling, or can you be short selling for days in a row? There's no limit unless something like the financial panic of 2008 exists, where they do put in certain restrictions as to maybe some stocks that you might be able to you might not be able to short, you might not be able to sell, Sebastian. But typically there is absolutely no time limit on anything to do with trading. What else have we got? Ryan, you're asking what is the best time of day to trade? Genuinely, the best time for anybody to trade is simply the best time for them to trade. There's no point in me saying to anybody, look, the best time to trade is between 2 p.m. and 3 p.m. Every single day, because that's not feasible for everybody. It doesn't mean that that is the best time, not at all. The best time for anybody to trade is when you're able to set aside maybe 15 minutes or 20 minutes or 30 minutes. You're able to apply yourself in a professional sense, in an undistracted and non-distracted sense, and just able to analyze markets, maybe place some pending orders, maybe adjust some pre-existing pending orders, and then go with that. Malcolm, you're asking, are markets more volatile upon opening? They tend to be, absolutely. What else have we got? Nikolai, you're asking how many markets should you trade on if you wish to make a meaningful profit, or if you are not trading on markets which are within floor-to-ceiling areas. We look at a little portfolio of maybe 10 to 15 different positions, or 10 to 15 different markets, Nicola. That's not a bad starting point. Then at the same time, if you want to start with just one position, that's absolutely fine as well. Dean, you're asking if I think it's possible to trade for too long each day. I absolutely do, Dean. I absolutely do. There is such a thing as over trading. It's best to get those kind of snapshots of the market for whatever it is, 15 minutes, 30 minutes, an hour maybe at most, there or thereabouts. Lawrence, you're asking what time frame I find best, and a daily candlestick chart is what I tend to use more often than not. Janet, you're asking, should you trade at the same times, or does it matter? It doesn't really matter, but I kind of like the consistency of trying to trade at approximately the same time. What else have we got? Farouk, you're asking what I think of the African markets. Nothing wrong with them whatsoever, Farouk. A market is a market, to be honest with you, as far as I'm concerned. Fabio, we're asking if we're going to cover a trading journal as well. We sure will, Fabio. We'll be doing it as part of, I think it's a final class. Lesson number 10 we'll be covering that at. What else have we got? Oh, Greggy, excuse me, you're asking what's the difference between investment funds, mutual funds, hedge funds, capital protected funds, private equity funds, and exchange traded funds. Ooh, Gregory, you know what? I'm going to have to take the fifth on that. Not out of anything other than it would take such a long time, I suppose, to go through the differences between all three. But that's the beauty of Google, or even Wikipedia. Go and type each and every single one of them into Google or into Wikipedia, and you'll get a much clearer example, a much clearer explanation than I would ever be able to do just by talking into a microphone. Yeah, Investopedia, that's not bad either. I think Investopedia is a bit too clogged for my liking at times with advertisements. But yeah, it's not bad. It's not bad. What else have we got? Yana, again, you'll have access to the recordings for at least 1 month after the entire course comes to an end. Michelle, you're asking about the time frame. We would look within a candlestick chart. There's no real way to answer that question, Michelle, to be honest with you. A daily candlestick chart, it probably defaults to about 6 months. You can zoom out to a couple of years if you wish, then zoom back into maybe 3 months. You know, anything that kind of gives you a good idea as to what's going on at the moment. Ashleen, you're asking any websites that I like or recommend. I suppose that there's nothing wrong with the popular ones, Ashleen, to be honest with you. Bloomberg.com, CNBC.com, MarketWatch.com, Reuters.com/business, even Google.com/finance. Like there's a realm of websites, as you can probably imagine, that cater for anybody who's looking for any information on any entity, on any market. Andrew, you're asking, can floors or ceilings diverge or converge? Yeah, they can to a degree, Andrew. We'll be covering that during the next class, lesson number 6. Essentially, they're kind of wedge patterns or triangles, and that's what we'll be doing at that point in time. Let me have a look. Ray, yeah, we're going to be providing you with your own practice trading platform next week during lesson number 7. What else have we got? Nick, yeah, you're asking if it's good to start with equities or commodities or currencies. A mixture of all three. Nothing wrong with it at all, Nick. It's probably better to be as diverse as you possibly can. Normally people tend to start off with markets that they have an interest in, you know, that they tend to follow anyway, and kind of take it from there. We'll cover it in a bit more detail as we progress, if we can at all. What else have we got? Nina, you're asking, is every single market open for every single citizen in the world? I would go with no in that, Nina. Not every single market is open for every single citizen. There are restrictions. There are restrictions even in the land of the free and the home of the brave. There are restrictions in the States that you're not able to trade highly leveraged markets, that your leverage is restricted. So there are restrictions. There are some countries which are banned, the likes of the normal kind of trade embargoes. I don't believe anyone in Iran is able to trade. I don't believe anyone in let me think of another one. I think there are even some restrictions in Turkey. I know there are restrictions in the likes of Panama, that kind of thing. So, you know, it does depend. It doesn't mean that every single person, but, you know, most are. John, you're asking what other markets are available 24/7 outside of Forex. Commodities tend to be, it's not 24/7, Johnny, it's 24/5, so 5 days a week. 24 hours a day, 5 days a week, not 24 hours a day, 7 days a week. So commodities tend to be, indices tend to be, that's pretty much it. So Forex, commodities, indices. Let me have a look. Ali, you're asking if you can earn a specific amount per week from living from financial trading. Of course you can, Ali. Of course you can. Let me have a look. Andrew, you're asking if it's better to trade the market when it is closed so that you can see the complete candlestick of the last day. Yeah, I like your thinking, Andrew. Unfortunately, it's not possible because you cannot place a trade on a market which is closed. You can't even place an order on a market which is closed. Let me have a look. Richard will be looking at moving averages, specifically in lesson number 8 next week. So moving averages will take up a lot of time during lesson number 8. It's always one of the more popular lessons. No trouble at all, Ray. Many thanks. Let me have a look. Greggy, we're just dealing with trading, I suppose. That's what we're interested in, day trading the financial markets. I think that's about it, guys. No, Bart, as I said, you can't place an order when the market is closed. The market has to be open in order for you to trade it. Okay, I think that's about it, guys. For practicing on a platform, we will be providing you with your own practice platform. It does come as part and parcel of this Foundation Trading Program course, and we'll be giving it to you next week. Shahrukh, apologies if I haven't gotten around to your questions. We'll try and deal with them afterwards if that's okay. There's a couple of people saying I didn't get to their questions. Massive apologies, guys. There are quite a few coming in. I was trying to cover as many as I could, even though I didn't call out your name. Maybe I was hopefully maybe giving reasonably general answers, so I was answering a multiple of questions at the same time to a degree, but I hope that's okay. If I did pass over everybody, Khalil M, if I did pass over your question, I do apologize massively. Do get in touch with us, pop us through an email, pick up the phone, give us a call, Khalil, if you wish, no problem whatsoever. We'll do our very, very best to help you out. You can see all the information that you need on screen. Other than that, guys, I hope you enjoyed the remainder of your week. I'll be back next week to continue on with lesson number 6, where we finish our technical analysis. It's 3 in a row next week. Don't forget that. We have lesson 6, lesson 7, lesson 8, all next week. So we have 3 in a row. It's our busiest week of the entire Foundation Trading Program. So until then, guys, many, many thanks, and I'll talk to you all again very soon. Take care for now. Bye-bye.